Hey CPA candidates, it's Matt from Universal CPA Review. In this video, we're going to introduce you to the concept of net working capital. We're going to talk about liquidity ratios. We're going to talk about the cash conversion cycle and the 4 key steps to calculating that, as well as working capital turnover ratios. Now, before we dive into the video, please subscribe to our YouTube channel. If you're looking to join some Facebook study groups for the CPA exam, join the Universal groups. The links are in the description of this video. You can also sign up for a free trial. Why not give it a try and see just how powerful visual learning can be? And then lastly, if you're looking to purchase the course, reach out to us, schedule a phone call. We'll share some information about current promotions and discounts, and you may be eligible for the Spilt Milk program. Now let's dive into the video. Today we are going to talk about working capital, liquidity ratios, the cash conversion cycle, and working capital turnover ratios. Now all of these metrics or ratios are used to help a company, investors, or really anybody understand the company's ability to meet its short-term debt obligations. Right? You would need to have certain liquid current assets like cash, accounts receivable, etc., to be able to pay off certain short-term debt obligations like accounts payable, accrued payroll, any other accrued expenses. Because when a company can't make those short-term debt payments, well, that could spell disaster for a company and they could go bankrupt. So again, the management team, any creditors, investors, they want to know how liquid is a company and will they be able to meet their short-term debt obligations. So the CPA exam loves to test this section. Again, there's a lot of ratios and metrics that we're going to go through. What I ask of you today is don't focus so much on the specific formulas, but focus more on the why. Why would somebody want to calculate this, and how can we use this to interpret the health of a business? So always be thinking about, well, what if this ratio goes up, or what if this ratio goes down? What does that mean for the company? So the basic formula for net working capital that we must remember is that it's just current assets minus current liabilities. And the place that we're going to be running through this module today is at Hawaii Surf. So imagine you're on the beach. Imagine you're enjoying this content, because I promise you, you're going to enjoy it. So we have the Hawaii Surf net working capital schedule, right? And this is a schedule we're going to use to calculate all of the metrics and ratios for the rest of the module, right? So this is very important. So as you can see on the current asset side, well, that's cash and cash equivalents, marketable securities, accounts receivable net, inventory, prepaid expense. There could be other current assets, but that is total current assets. And then for total current liabilities, we have accounts payable, accrued expenses, and other current liabilities, right? Is endless options for both, but this is just a basic schedule. So if we wanted to calculate net working capital, we would just take total current assets, say for year 3 of 115,000, subtract current liabilities of 42,000, and for year 3, we would have net working capital of 73,000. If we did the same calculation for year 2, we would have net working capital of 66,000, right? So fairly basic formula. You should be able to understand how to calculate net working capital based on a company's balance sheet. Now for the CPA exam, there are 2 different types of liquidity ratios that they love to test. And these liquidity ratios are basically used to indicate a debtor's ability to pay off all current obligations without needing to raise additional capital, right? So that's a bit more technical. If we want to simplify it, we're just trying to compare the amount of current assets that a company has that they could use to pay off the current liabilities. So the 2 ratios are the current ratio and then the quick ratio, which is also known as the acid test. So let's go through each of them separately. So starting with the current ratio, the formula is simple. It's just current assets divided by current liabilities. And the result will tell us the ratio of assets to liabilities, right? And so if we're thinking about, do we want to have more assets than liabilities? The answer is yes. And so we want this ratio to be greater than 1. In fact, we want it to be as high as possible, because the higher the ratio, that means they have more assets relative to current liabilities. So going back, we're sitting on the beach at Hawaii Surf, and we have our balance sheet, and we need to calculate the current ratio. So for year 3, well, it would be current assets of $115,000 divided by current liabilities of $42,000. And that results in a current ratio of 2.74. So as you can see, that means they have 2.74 times as many current assets as they do current liabilities. Now, we don't know if this is a great current ratio. We would have to compare it to historical or to other peers in their industry, right? And creditors, investors, anybody would be looking at this trying to understand, okay, can they make these short-term debt obligations? Well, probably, right? Because they have 2.74 as many current assets as they do current liabilities. So real quick, let's talk about the risk related to the current ratio. So if we think about current assets, it has an inverse relationship with risk. So if we talk about wanting to reduce the risk in an organization, well, then we would increase current assets and the risk will go down, right? Because we have more current assets to pay off those current liabilities. And if we want to decrease our assets, well, that could increase the risk, right? So there's an inverse relationship between current assets and the current ratio. Now, when it comes to current liabilities, it's more of a direct relationship, meaning as our current liabilities increase, the risk will go up, right? We have to pay off more short-term debt. If they go down, the risk also goes down, right? So the exam loves to test your ability to understand, okay, if there's a change in the current ratio, either up or down, how does that impact a company's risk profile? Our second liquidity ratio is referred to as the quick ratio, and some will also call it the acid test. Now, as you can see, the formula, it's cash and cash equivalents plus marketable securities plus receivables net. And that will include accounts receivables, notes receivables, and other types of receivables. And then on the denominator, we have current liabilities. So when we think about what is the key difference between this and the current ratio, well, you'll notice it excludes certain current assets like inventory and prepaid expenses. And why do we do that? Well, a company, they cannot convert inventory or prepaid expenses into cash as quickly as they can these 3 items, right? So this is a more severe liquidity test because it only focuses on types of current assets that are more liquid, right? Things that we can convert to cash or already in cash to pay off those short-term liabilities, right? So if a company is wanting to understand how good their liquidity is, well, if they want to be more conservative, they would use the quick ratio rather than the current ratio. So we finished up laying on the beach. Now we're back at the beach club at Hawaii Surf, and we're going to calculate the quick ratio with some of our friends, right? We're drinking a few beers and we're going to calculate this ratio. So you can see for the numerator, we're only going to include cash and cash equivalents, marketable securities, and accounts receivable, which totals to $48,000. On the denominator, we're still using total current liabilities, right? We're not excluding anything. And that is $42,000. And that results in a quick ratio of 1.14. Right? So the company, they still have more liquid current assets, even when we exclude inventory and prepaid expense, than they do total current liabilities. Right? So that is how we calculate the quick ratio. Now, similar to the current ratio, when we think about the relationship between current assets and risk, well, as current assets goes up, risk goes down, right? So there's an inverse relationship. And when we think about current liabilities, well, same thing. When that goes up, it's riskier for the company because they have more debt to pay, right? So there's a direct relationship there. So again, always be thinking about how a company can either increase or decrease their quick ratio and how that impacts risk and both the current assets and current liabilities of the business. So the last thing I want to quickly recap on is the current versus quick ratio. The exam loves to test whether you can calculate both of these ratios. And what they'll do is usually give you a handful of balance sheet items, and you'll have to know which items to include or exclude for both of these ratios. Right, so as you can see, again, the key difference is the numerator. And when we look at this visual here, you can easily see what is included versus excluded for both of these ratios. And so really the key difference, again, it's focusing on those items that we cannot quickly convert to cash, and those are excluded from the quick ratio. So the main items that you'll see in the exam that are going to be excluded if they ask you to calculate the quick ratio, well, it's going to be inventory, prepaid expenses, and other current assets. Those are either not already in cash or can't easily be converted to cash in a short period of time to pay off those short-term debt obligations, right? So that is why they're excluded from the quick ratio. So remember this table. You'll see some example multiple choice questions where it asks you to calculate the quick ratio, and they're going to give you inventory, prepaid expenses, and you'll have to know to exclude those from the numerator. The next metric that is related to working capital and the company's operations is the cash conversion cycle. And the cash conversion cycle is considered a metric that expresses the length of time in days that it takes for a company to convert an investment into inventory back into cash flows that can be used in other areas of the business to grow. And so as you can see, the formula, it's not too difficult. We start with days in inventory, which I'm also going to call DIO, which stands for days inventory outstanding. Those are interchangeable. And then we would add in days sales in AR, which the acronym is DSO, which stands for days sales outstanding, right? They're the same as well. And then we would subtract days of payable outstanding, which is DPO, right? So DIO plus DSO minus DPO. That is the cash conversion cycle. So here is our mental map for the cash conversion cycle. So if you see a question related to any one of these three ratios, as well as what is the cash conversion cycle for a company, this is your mental map. It will guide you on the different calculations and the roadmap to coming up with the answer. So as you can see in step one, to calculate days in inventory, we would take ending inventory and then we would divide by the result of COGS, cost of goods sold, divided by 365 days. And this is basically just daily cost of goods sold. And we want to know, based on that average, right, over a period of time, how many days of inventory do we have left? Right, that will tell us, if we have 30 days, well, we know that we have 30 days more of inventory based on that ending inventory balance. Now for step two, this is the days sales in AR, also called DSO. And again, we're using ending accounts receivable. And this time we divide by sales divided by 365 days, right? That is basically just daily sales. And so if our day sales in AR is 30 days, that means we have 30 days of AR to collect. So then we move to step three, which is days of payables outstanding, or DPO. And this time we use ending accounts payable. So you'll notice for the cash conversion cycle, in all three ratios, we use the ending balance. We want to know basically at the end of the year, here's the balance. How much of each of these in days do we have? All right, so for DPO, it's ending accounts payable divided by COGS divided by 365 days, right? So you would do daily cost of goods sold calculation first, and then divide that into ending accounts payable. And then in step four, only after we've calculated those first three steps can we calculate the cash conversion cycle. And that's DIO plus DSO minus DPO, and that equals the CCC, or the cash conversion cycle. And for a company, they want this to be as low as possible, meaning we want the number of days for the cash conversion cycle to be low as possible, because that means the company can quickly purchase inventory, manufacture inventory, and then sell to customers and get the cash, right? So that is extremely important in understanding how a business can fund future growth within their cash conversion cycle or their operations, right? Because if they need more cash, well, if they can't get it quickly from the operations of the business, that means they have to go externally to raise cash. So now we're going to do a little deep dive on each step of our mental map. So starting with days in inventory, again, this is also called days inventory outstanding or DIO. And again, the formula was ending inventory on the numerator, and then on the denominator, it's basically daily cost of goods sold, which is calculated as cost of goods sold divided by 365 days. And we're always going to use 365 days for the CPA exam, right? That is a full year. So looking at our example for Hawaii Surf, if we wanted to calculate days in inventory for year 3, well, we would take the $52,000 of ending inventory on the numerator, and then on the denominator, we would take $350,000 of cost of goods sold, divide by 365 days, and that is daily cost of goods sold of $959. Right, so if that's our daily average and we have $52,000 worth of inventory on our balance sheet at the end of the year, that means our days in inventory is 54.2 days. So there's two ways we can look at this. It's either it takes us 54.2 days to purchase, manufacture, distribute, and sell inventory, or we have 54.2 days worth of inventory left on our balance sheet at the end of year 3, right? So both of those are ways we can interpret it. And for a company, they want this ratio to be as low as possible because it means they can do all of that purchasing, manufacturing, and distributing of inventory and then sell it in a short period of time. So step 2 of our cash conversion cycle was days sales and accounts receivable. This is also referred to as days sales outstanding, which is DSO. And this is just basically measuring how long it takes for a company to collect accounts receivables from their customers, right? So as we learned, when a company sends an invoice, they record the accounts receivable. And if they have 30-day terms, meaning the customers must pay them in 30 days, well, most customers will take the full 30 days. And so if we're thinking about how long it takes for a company to collect their accounts receivable balance, well, it's usually going to be reflective of what their credit terms are, right? So if they have terms of net 30, well, then their DSO is likely around 30 days. So our formula for days sales and AR, it was ending accounts receivable. Notice we're taking the ending balance sheet amount, and then we would divide by daily sales, which is just sales divided by 365 days. So going back to Hawaii Surf, if we wanted to calculate the day sales and AR as of year 3, well, our ending AR balance is $35,000, so that's on the numerator. And then for the denominator, we would divide sales of $550,000 by 365 days. That means daily sales is 1,507. So ending AR of 35,000 divided by daily sales of 1,507. That means our day sales in AR are 23.2 days. So on average, it takes the company 23.2 days to collect their AR from customers. It also means that they have 23.2 days worth of sales in their ending accounts receivable balance, right? So that is how we interpret it. For a company, they want their day sales in AR to be as little amount as possible, right? So the shortest amount of days as they can get it. Moving on to step 3 of our mental map. This is days of payables outstanding, right? And the company has more control over this. They determine when they actually want to make payment on their payables, which is recorded in accounts payable. So our formula was ending accounts payable on the numerator, and then on the denominator, we're back to daily cost of goods sold, which is cost of goods sold divided by 365 days. right? Because when a company purchases materials for inventory, well, there's an associated invoice that gets recorded in accounts payable. And the company, well, there's going to be credit terms that they have to abide by, but they may decide to wait 7 days to pay it, or they could wait up to 30 days. So whatever this ratio is, indicates how long it takes for a company to actually pay off the invoice from the date they received it. So it's getting late in the afternoon at Hawaii Surf. The sun is starting to set. It's the golden hour. And we're going to sit there and talk with our newfound friends about how to calculate this ratio. So ending accounts payable from our year 3 amount, right, is $24,000. And then daily cost of goods sold is still $959. Right, we take $350,000 worth of cost of goods sold, divide by 365 days. And when we do 24,000 divided by 959, that equals a DPO, or days of payable outstanding, of 25 days. So that means from the time that Hawaii Surf receives an invoice for items they've purchased, it takes them 25 days to actually pay the supplier or vendor the cash, right? So that is our step 3 for the cash conversion cycle. So in step 4, since we've calculated steps 1 through 3, we are now ready to calculate the cash conversion cycle. We start with DIO because we purchase materials first, and that was 54.2 days. And then we'll add in the DSO, or the days sales in AR, which is 23.2 days. And then we'll subtract out the days payable outstanding, which is 25 days. And that means the cash conversion cycle for Hawaii Surf is 52.4 days. So a lot of things go into the cash conversion cycle, but ultimately this is how we would calculate it for Hawaii Surf. The inventory turnover ratio is the first turnover ratio we'll talk about. So on the numerator, it's cost of goods sold, and then on the denominator, it's going to be average inventory, which again is just the average between the beginning balance and the ending balance. So going to our Hawaii Surf balance sheet, it's now late into the night. Well, for the numerator, we would have cost of goods sold of $350,000 for year 3. And then for the denominator, it's the average between the year 2 ending balance, which becomes the year 3 beginning balance of $50,000, and the ending balance for year 3 of $52,000. That averages out to $51,000. And so cost of goods sold of $350,000 divided by average inventory of $51,000, that equals inventory turnover of 6.9 times. So in that 1 year period, the company flipped or sold through their inventory 6.9 times. And a company wants to have this ratio as high as possible because that means they're purchasing, manufacturing, distributing, and selling it more quickly. And this reduces the risk of obsolescence, and overall, they're getting cash back faster from that investment they made, right? So similar to days in inventory, but this is just another way to assess how quickly a company is flipping through their inventory. So if we think about how to interpret this ratio, well, if we think about cost of goods sold, there is a direct relationship with inventory turnover. So if cost of goods sold are higher, that means we've sold through more inventory, which is good. That means they've had higher sales. And so if that increases, so does inventory turnover. So that means there's a direct relationship there. Now, if inventory turnover is higher, that means average inventory is lower, right? So there's an inverse relationship between the inventory turnover ratio and average inventory. So if we want to increase that ratio, we either have to increase cost of goods sold or decrease average inventory, right? Because as a company, we want our inventory balance to be as low as possible. Because when an inventory balance is high, it means there's a lot of cash tied up in inventory. And we want to reduce the amount of cash that is tied up in inventory, so we want that balance to be as low as possible. The next turnover ratio is the accounts receivable turnover ratio. And similarly, on the numerator side, we have an income statement account, specifically sales net, right? Because it's related to accounts receivable. And then on the denominator, we have that average accounts receivable net. right? Again, it's the average. Got to remember that. And so when we look at the Hawaii Surf balance sheet, which now it's getting really late into the night, if we want to calculate the accounts receivable turnover, well, on the numerator, we'll have sales of $550,000 for year 3. And then we would take average accounts receivable, which is just the average of $30,000 and $35,000, which is $32,500. So sales of $550,000 divided by average accounts receivable of $32,500, that equals a turnover ratio of 16.9 times. So this was over a 1-year period, and if they flipped it 16.9 times, that means they're flipping it more than once per month. And if we think back to what our DSO was, right, that was less than 30 days, so it makes sense, right? It was 23.2 days. So every 23 days, they are flipping their accounts receivable balance or completely collecting all of the balance outstanding, right? So this company, it appears they're doing a great job of collecting their receivables because, as we know, the longer they stay outstanding, the risk of uncollectability goes up, right? If our customers pay us within 20 days on average versus 50 days, well, I would rather have my customers pay me sooner than later because, as we all know with our friends, the longer it takes for them to pay us back, the less likely it is that they actually pay us back. We all have those friends. So if we think about the direct relationship and the inverse relationship with accounts receivable turnover, well, credit sales, because it's in the numerator, would have a direct relationship. So as credit sales increases, which is the numerator, so will the accounts receivable turnover ratio. And if average accounts receivable decreases, it has an inverse relationship with the AR turnover ratio. So remember, credit sales, direct relationship, average accounts receivable, the denominator has an inverse relationship. Now we're going to move on to the accounts payable turnover ratio, very similar to the inventory and accounts receivable turnover ratio. In the numerator, we have that income statement account, the cost of goods sold, and then in the denominator, we're still taking the average accounts payable balance, right? Again, very important to remember it's the average. So now it's just about midnight at the Hawaii Surf Club. We're still talking about these ratios with our newfound friends. So for AP turnover, we would take cost of goods sold of $350,000 for the numerator, and then average AP, well, that would be the $20,000 and the $24,000, which averages to $22,000. So that results in an AP turnover ratio of 15.9 times. Throughout that 12-month period, they completely flipped through or paid off their payables 15.9 times. That's how we interpret this ratio. Our last turnover ratio is the overall working capital turnover ratio. And so on the numerator, this is going to be sales. On the denominator, it's average working capital. And this just helps us understand how efficiently a company is at utilizing its working capital to generate sales. So a company with a higher working capital turnover ratio would be more efficient, while a company with a lower working capital turnover ratio would be less efficient, right? So you want to be more efficient, meaning you want this ratio to be as high as possible. And so when we think about our example here, it's now midnight. We might be celebrating New Year's Eve, or it might just be a random Saturday night, but we're still at the Hawaii Surf Club. So on the numerator, it's going to be $550,000 worth of sales. And then for the denominator, we're taking average working capital, which is $66,000 plus $73,000 divided by 2. And so that equals $69,500 of average working capital. That results in a working capital turnover ratio of 7.9 times. So that means based on company sales, they are completely flipping through their working capital 7.9 times per year. So if we think about the relationship, well, as sales increase, so will the working capital turnover ratio. So there's a direct relationship there. The inverse relationship is average working capital. As that increases, the working capital turnover ratio will decrease, right? So if we want to increase our efficiency for using working capital, we either need to increase sales or decrease that working capital balance on an average basis, right? So overall, working capital, very, very important for the exam. Important to understand all of these ratios, but more important, it's your ability to interpret these ratios and use them to help make business decisions, right? That's ultimately what you will need to do as a CPA. You'll be able to understand financial statements, calculate these ratios, and then convey to your clients how they can improve their efficiency and operations in the business, right? So that is why this is tested on the exam, and that's why it's important for you to understand it.